How's it going, YouTube? I'm Ari, and welcome to my channel where we are talking everything value investing and of course dividends as well. Now, if this is your first time stopping by, I want to quickly catch you all up to speed in sharing with you that this whole journey started back in 2019 from scratch, zilch, zero, zippo, and the mission was quite simple. It was just to get to $100,000 with my Vanguard brokerage account while showing you all through just how simple the investment process is, as long as we're not gambling or trying to just get rich by Tuesday. So with that said, my account is now sitting at $108,441.09. As for today's video, I wanted to go ahead and talk about the market from a macro point of view, because since my last video, a lot has changed from inflation to the very sentiment on the street for investors. And then I just want to keep everybody updated with my personal portfolio and diving into the one energy stock I just sold out of before jumping into the healthcare investment that I've actually just doubled down on. Now, as always, before we get to it, tap on that thumbs up button to help me grow this channel. And of course, if you haven't already subscribed, make your way over to doing so. I'd certainly love for each and every one of you to be on this journey with me. Now let's get right to it.
Well, we've just gotten, obviously, a week of relief on some inflation measures. Naturally, CPI, PPI index, University of Michigan sentiment, the inflation expectations did moderate to some degree. That follows the New York Fed survey in a similar direction. How does this all filter into your view of whether the Fed is on course to get inflation back to target, what it means for policy in the near term?
Well, Wednesday's data, the PPI data yesterday was all very welcome. So we're happy to see inflation start to move down. And I'd like to see a period of sustained inflation under control. And until we do that, I think we're just going to have to continue to move rates into restrictive territory.
Consumers grapple with inflation. New data points show it may be slowing. Wholesale prices rising 9.8% in July compared to a year ago. But the bright spot, wholesale inflation fell 0.5% in July versus the previous month.
I do think people are over-focused on the direction of change, what I call derivitis, which is too much focused on the derivative. So inflation is commutative, meaning 2% followed by 3% followed by 4% followed by 5% is just as bad but no worse than 5% followed by 4, then 3, then 2. The order doesn't matter. And so people get too excited about a change in the rate of inflation. We still have very high inflation. We still have very negative real rates of interest, and negative interest rates prop up growth stocks and are relatively good when they change to value stocks. I said a lot there, but people are too positive about a decline from very high inflation rates.
Inflation came in better than expected. They can't celebrate. In fact, you've had a few Fed speakers come out already and say it's early days and we're not going to stop hiking.
So we certainly have a ton to unpack, and I'm sure you've heard by this point in time, just given the consumer price index report has been out now for a handful of days, but inflation seems to be cooling down, with the latest CPI report depicting inflation coming in at 8.5%. That's actually slightly better than the expected 8.7% from both economists and analysts. Now, if you recall, the jobs report came in just days prior, to which the United States added over 528,000 jobs to the U.S. economy, ultimately meaning the labor market is incredibly strong and only growing stronger. So far, all good news, which sparked the major indexes to rally, with the Nasdaq seeing a 20% jump from recent lows and the S&P climbing to some of the highest levels that we haven't seen in about 3 or so months. However, we need to keep in mind that we've seen inflation come down before, actually reigniting to some higher highs. So we need to see consecutive months worth of deflationary movement in order to build more overall market confidence. It's therefore important to keep in mind that we still have one more CPI reading before September, when the Federal Reserve will actually come out and again raise interest rates. The question is not whether they're going to do it, but just by how much. Now, if the CPI reading is another notch lower, the Federal Reserve is likely to pump the brakes on raising interest rates aggressively, but if not, of course, they're going to act more aggressively, which would spook the market itself. So now, what does that really mean for all of us investors? We're not exactly in the clear just yet, so we shouldn't be YOLOing or throwing all of our money into the market, but rather sitting tight on some cash and, of course, with some patience. Now, as for my personal portfolio update, I sold out of one stock and increase my position with another. The stock that I sold out of entirely was Brookfield Renewable Partners, that's ticker symbol BEP, which owns and operates one of the largest portfolios of renewable energy facilities with a global footprint expanding well outside the United States to Europe, Colombia, and Brazil. Now, the company itself was incorporated rather recently in 2019, which is when I actually initially invested into it. Whether it's hydroelectric, wind, or solar power plants, Brookfield does it all, and in my honest opinion, may still be an incredible opportunity for investors over the long haul. However, since I began investing into the company, the stock has only been trading sideways. And while I do think that the future of energy is ultimately green and clean, especially with recent news on the climate bill passing, I think there are just better opportunities out there and more profitable ones, to say the least. It's just my opinion, but for example, NextEra Energy is on my watch list and of course at the right buy-in price. Nonetheless, as I work to continuously trim down my portfolio, Brookfield just wasn't making the cut, so I put a little over $1,100 back into my pocket to reinvest elsewhere, selling out of my position with Brookfield, and happily brought my portfolio down to 29 total holdings. As for the healthcare stock that I decided to scoop up more shares of and double down on, it is the ultimate Johnson & Johnson, ticker symbol J&J, which is, as you all know, a leader within the healthcare industry with over 135 years worth of revolutionizing the industry, and for as far as I can see, will only likely continue to do so. As a matter of fact, their new CEO even just pledged a decade worth of innovation like we haven't seen from Johnson & Johnson previously when it comes to both their medical devices and their pharmaceuticals. Now, at this point in time, their market capitalization is sitting at $434 billion, which is well above many of their competitors. In regards to recently pulling the trigger and scooping up more shares worth of Johnson & Johnson, yes, I have a goal of getting this position to 100 shares, but I decided to press forward with a buy-in right now because the stock has been sliding lately. It fell below $170 per share with a PE that is still rather high at 24, but I think it's Buffett's price is what you pay, value is what you get principle that's suitable here. And even though it topped Wall Street's earnings expectations with drug sales leading the way, its share price has been sliding because of rather weak guidance, which in my opinion is just ridiculous, especially with their promising new blood cancer drug on top of legal battles that are in fact fading into the past. Therefore, I went ahead to pick up 3 more shares in my Roth IRA and 2 more shares outside of my retirement accounts for a total of $839.14, bringing my total share count of Johnson & Johnson up to 55 shares. Now, looking ahead, analysts of course foresee future growth coming in at a target price of $187 per share and even higher target share price here of $215 per share. As for a dividend investor like myself, investing into a dividend king is key. Johnson & Johnson will ultimately pick up that momentum, but until it does, just collect on a dividend coming in at 2.73%. Now, YouTube, that is it from selling out of Brookfield Renewable, adding shares of Johnson & Johnson. Those are the investment moves I've been making this week. I'd certainly love to know if you've been buying into any positions or selling out of any of them. Let me know down in the comments below. And of course, keep in mind I am not a financial advisor, so just always do your due diligence following my videos. But before we get going, you know what to do, and tapping on that thumbs up button to help me grow this channel, and of course, subscribe if you haven't already. Now, YouTube, until the next video, I will see you all there.